time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
We got a question from Ronan on Keysight Technologies, symbol Keys or KEYS on the New York Stock Exchange. It is a leader in the field of testing and measurement, helping electronic OEMs and suppliers alike bring products to market to fit industry standards and specifications, effectively the American testing equipment. Keysight specializes in the communications market, but also supplies into the government, automotive, industrial, and semiconductor manufacturing markets. Keysight solutions include testing tools, analytical software, and services. The stock is currently trading at roughly $156 and a market cap of $28 billion, trading down roughly 8% year to date. So, getting into the income statement, the company released its Q1 fiscal Q1 2023 results in February. The market reacted negatively, sharply causing the share price to drop 13% overnight. Revenue grew 10% to $1.3 billion, or 14% on an adjusted core basis, which removes the impact of foreign exchange and acquisition debentures. You'll commonly see this adjustment for various companies. GAAP net EPS increased 17% to $1.45 per share from $1.24 per share compared to the prior year. Non-GAAP EPS, which adjusts for the acquisition as well as share comp and some other tax-related expenses, grew 22% to $2.02 per share from $1.65 last year. Overall, the company had solid growth, so why did the shares drop? Really, it comes down to the forward-looking aspect. The company also releases its orders, which fell 13% year over year to only $1.3 billion. Part of the reason why is the suspension of its business in Russia, as well as heightened Chinese restrictions, which accounted for 350 basis points or 3.5%, but roughly it's 10% from other causes. The main cause just being in macroeconomic uncertainty. The company still has $2.5 billion in backlog, roughly half a year worth of revenue, so it's not like it's a dire straits situation. They're not falling apart by any means with this drop in orders, but it is still concerning looking forward in the short term. Looking at the company's balance sheet, the company has a quite strong balance sheet with a net cash position of $207 million because it has $2.2 billion in cash and just over $2 billion in debt and leases. So it's quite a great shape with this net cash position, as well as able to service this debt, as it is constantly free cash flow positive, which is just operating cash flow minus their purchase of property, plant, and equipment. So really, they're able to keep growing their business while they're able to service their debt. And as well, on top of that, they're building a cash position. So looking at its growth potential, the company does have avenues for growth despite the short-term weakness. The company once again raised these expectations going forward during its 2023 investor presentation. Keysight has a strong market share within its current segments with long-term growth rates of 4 to 6%, as well as the company expects to outgrow these 4 to 6% by 1 to 2% additional for a total of 5 to 7% for the company in the long term. So despite the downturn in the short term, we're likely to see growth return in the long term once macroeconomic conditions turn more positive. The company is guiding non-EPS for Q2 fiscal Q2 2023 of $1.91 to $1.97, which would imply growth using the midpoint of 6% for the quarter year over year compared to the fiscal 2022's $1.83. So moving to valuation, the company has a GAAP PE of 24 times and a non-GAAP PE of 20 times, and a price to trailing free cash flow of 25 times. Altogether, these seem slightly expensive, but it is given the short-term headwinds, but it's not absurdly overvalued, given it's had a great track record since it's spun out in 2014. So overall, our take on Keysight is it's a strong company operational, but it's trading at near or slightly above fair value at this time. I would like to see how it navigates the worsening conditions because it has never been through poor macroeconomic conditions because it was spun out in 2014. And specifically because it does have exposure to the semiconductor space, see how that goes going forward. But long-term, the company likely does have potential, but you need to pay the right price for it.
Yeah, I was looking at analyst estimates here. So it looks like they're estimating about 4% earnings growth this year, which kind of coincides more or less with the company's quarterly guidance, right? Mid single digit. Mm-hmm. And then with growth presumably expected to pick up going into next year, but nobody knows what's going to happen next year. That's based on a lot of assumptions. So.
Yeah, and do you want to pay 24 times earnings for something that's maybe growing at what is it, 6%? Is that what the growth rate was? Yeah, a little pricey.
Yeah.
Yeah, so I would agree. Fair value
for sure. I mean, a lot of the forward-looking, it's the forward-looking statements that we've been seeing that have led to the drops in many of the names. Some have had good solid quarters, but it's the forward-looking statements, and we continue to see kind of cautious statements from the C-suite names, whether it be small, mid, or large cap companies of businesses that we're following directly and just observing. They're forecasting this recession that seems to be kind of the most forecasted recession ever, but it's really yet to truly hit. So we'll continue to monitor that. But many businesses just keep saying, we see a cautious environment heading forward or a lower environment. And, I don't think all of the names are going to be wrong. So we'll continue to position ourselves appropriately.
Well, I care less about what the economists are saying. I read the conference calls, I read the press releases, and talk to the management teams. And generally speaking, in most industries, they have felt a slowdown. I mean, they are talking about customers being more careful. For example, like the trucking industry, the prices were just red hot higher through 2022. Now there's some pushback on that. Other industries, it's similar. Technology,
job cuts,
companies
massive.
that just every year they grow. Yeah, it's a lot of these companies will still grow or they'll do all right, but not as well as they've done.
So when we say
huge inventory buildup.
You go, Brandon.
Go on. No, that's all I was going to say is just clothing companies we've been seeing too, huge inventory buildup and reducing order sizes. Go on.
And we got to be cautious. All the figures we're looking at in these quarterly numbers are 3, 4, 5 months ago. And these the indicators that you're really using to look forward, a great indicator is to talk to management teams that you do trust and that you've seen be right on the money, and they'll tell you exactly what they're seeing right now, and that's more appropriate going forward than sometimes looking back 3-4 months to a time where you didn't have the concerns that you may have now and you're seeing actually. But then again, you can't get micro-focused just on this 3-month period. If you've got a great company that comes on sale right now, we might see that. Yeah. And you think 2-3 years forward, maybe they have a momentary blip for a couple quarters. That can be your opportunity. So those are the things we watch for as well.
Mm-hmm.